Have you ever wondered what really happens when a bank fails, and what that means for your money, your savings, and the wider economy? In recent years, we've seen headlines about major bank collapses that shook markets and left customers anxious. But what does a bank failure actually mean? And how do regulators make sure ordinary people don't lose everything when it happens? Hi, I'm Wanda Rich, editor of Global Banking and Finance Review. Today we're taking a closer look at bank failures, what causes them, how they unfold, and what protections are in place to keep your money safe. Let's start with the basics. A bank failure happens when a bank can no longer meet its financial obligations. In simple terms, the bank runs out of money, or its assets, things like loans and investments, lose value to the point that it can't pay back its depositors. When that happens, regulators step in to take control of the bank, protect customers, and maintain confidence in the financial system. In the United States, that job falls to the Federal Deposit Insurance Corporation, or FDIC. The FDIC was created during the Great Depression, a time when thousands of banks collapsed and people lost their savings overnight. Today, the FDIC insures deposits up to $25,000 per depositor, per bank, per account category. That means if your bank fails, your insured deposits are still safe. And in most cases, customers can access their money within just a few days. But why do banks fail? There are several reasons, and most failures are the result of a mix of factors rather than one single mistake. Sometimes it starts with bad loans. If a bank lends too much to risky borrowers who can't repay, the losses begin to add up. Those unpaid loans reduce the bank's assets and weaken its financial position. Other times, the problem is interest rate risk. When interest rates rise quickly, like they did in 2022 and 2023, the value of a bank's older, low-rate investments can fall sharply. If the bank needs to sell those assets to raise cash, it may have to take a big loss. Then there's liquidity risk, which simply means the bank doesn't have enough cash on hand to meet sudden withdrawals. If depositors lose confidence and rush to pull out their money, even a healthy bank can run into trouble. That's what's known as a bank run, and in today's digital world, it can happen faster than ever before. People no longer line up outside bank branches. They move their funds online with a few clicks. A recent example is Silicon Valley Bank, or SVB, which collapsed in March 2023. The bank had invested heavily in long-term government bonds that lost value as interest rates rose. When customers, many of them technology companies with large uninsured deposits, learned about these losses, they panicked and withdrew billions in a matter of hours. The bank couldn't keep up, and regulators shut it down. Just days later, Signature Bank and First Republic Bank also failed, sparking fears of a wider banking crisis. But regulators acted quickly. They guaranteed customer deposits and arranged sales of the failed banks to stronger institutions. Those actions restored confidence and prevented further panic, a reminder that swift intervention can stop a problem from becoming a full-blown crisis. These events revealed just how fragile confidence can be in modern banking. Even well-established institutions can unravel quickly when depositors lose trust. That's why transparency, risk management, and strong regulation are critical. So, what exactly happens behind the scenes when a bank fails? Once regulators determine that a bank is insolvent, they take control, close it for business, and begin what's called a resolution process. They transfer insured deposits to another healthy bank or create a bridge bank to handle the failed institution's assets and liabilities. The goal is to make sure customers can access their insured money as soon as possible and to minimize disruptions to the broader economy. It's important to note that not all bank failures are catastrophic. In fact, most are handled quietly and efficiently. Customers often don't even notice a change beyond a new name on their bank statements. The FDIC and other regulators have decades of experience managing these situations to protect both depositors and financial stability. But there are lessons for everyone. For individual customers, the biggest takeaway is to understand deposit insurance limits. Make sure your accounts stay within insured amounts, or spread large balances across multiple institutions if necessary. For businesses, it's vital to monitor the health of your banking partners, especially if your deposits exceed insurance coverage. For investors, bank failures are a reminder of how interconnected financial markets can be. When confidence in one bank falls, it can spill over into others, especially those with similar risk profiles. That's why central banks and regulators constantly monitor liquidity levels, lending practices, and capital strength across the sector. And for the broader economy, bank failures remind us that stability isn't automatic. It relies on sound management, prudent regulation, and informed customers. The 2023 failures led to new discussions about tightening oversight for mid-sized banks and strengthening capital requirements to better withstand shocks. Still, it's important to keep things in perspective. While bank failures make dramatic headlines, they remain relatively rare. Out of thousands of banks operating globally, only a handful fail each year, and most depositors never lose a cent. That's a testament to the safeguards that have been built into the financial system since the crises of the past. So, what can you do to stay protected? First, know your bank's policies and insurance coverage. Second, keep an eye on financial news and reports from regulators. They often flag emerging risks early. And finally, diversify. Just as investors diversify their portfolios, consumers can benefit from spreading their deposits and keeping some funds in different types of accounts or institutions. Bank failures are complicated events, but understanding them helps take away the fear and uncertainty. They're not just stories about balance sheets. They're lessons about trust, transparency, and the importance of a strong regulatory safety net. In the end, the stability of our financial system depends on confidence. Confidence that banks will operate responsibly, that regulators will act decisively, and that customers will stay informed. So the next time you see headlines about a bank in trouble, remember, the system is designed to protect you. Bank failures may shake markets, but they don't have to shake your peace of mind. I'm Wanda Rich, and this has been Bank Failures Explained, what you need to know. Join us again as we continue to make the world of finance clear, relevant, and accessible.